Good morning, everybody, and welcome to the launch of Boring Money's fifth annual report into sustainable investing. I'm just going to check the volume is working and I'm coming through, perhaps on the chat bar. If people can hear me, just let me know. Brilliant. All good. Always worth checking before I have an interesting chat to myself for half an hour. I'm joined by our head of research, Jim Adams, and together we're going to walk you through our latest report on sustainable investing. One thing, before we kick in, we have some polls, so I'd just like to sort of get you guys to share some views with us. If you click on the right-hand side of your screen on the polls bar, there's a couple of questions there. We're interested to get your views on what percentage of investors rely on centralized investment propositions for sustainable investing. So they defer to someone else rather than doing their own research. Answers coming in there. If you look down, we also want to ask you which issue you think consumers care most about. So when we talk to people about their investments and how they want to back these issues with their investing, there's a couple of issues there. And which asset class are investors most likely to consider over the next 6 months? So we can come back to those during the presentation. If you could share a view with us, that would be fantastic. Thank you very much. So on the cover here, you can see our 7 personae. We're going to go into in more detail throughout the presentation, but we work very hard to segment the investor audience. They have very different views on what ESG means to them and their investment approaches. Last year we had 5, so we have updated it this year to reflect the more nuanced views that are emerging about particularly fossil fuels, and also a new cohort that we called social champions to reflect the growing awareness of the S part of ESG. So we'll talk through that. Mike, could you move to the next slide, please? This year's report, drum roll. It's been designed to help advice firms, to help investment platforms understand what their investors are likely to be researching and interested in, and asset managers as well in understanding how well their brand is resonating with people, which particular cohorts their brand is resonating with, and what future intentions are. One thing that stood out loud and clear for me this year in the report is the ongoing work we need to do with communications. Obviously, there's regulation coming down the track about sustainable disclosures, but from a customer perspective as well, there's still an awful lot of confusion, and we also note continued growing skepticism about greenwashing from both investors and advisors. There's a lot of deep dives we do into the data, into the personae, into the segmentation, which we can map to your particular segments and cohorts as well. So get in touch with us if that's of interest. Next slide, please, Mike. There's a lot of topical questions in there as well. We wanted to know how the short-term performance has impacted investors and sentiment out there as well. Obviously, fuel in the news all the time, and so there are many prevalent views about fossil fuels. That continues to be the thing that exercises people the most. We did want to see if people's views on weapons and exclusions in that area had changed in light of activity in the Ukraine. The headline answer to that is no. That hasn't really trickled down through to the sort of retail investor sentiment about weapons. There's some debate in more institutional circles about that, but that's still to sort of permeate the retail investor mindset. And the spoiler alert here, are people still committed to investing in sustainable funds? Broadly, yes. And there is ongoing appetite and interest we're going to evidence despite shorter term performance issues. If we just check in on the polls before I dive in sort of further, the majority of you think that it's sort of mixed bag, that 56 to 70% of advisors rely on centralized investment propositions. That is in fact correct. The answer is 60%. So well done to those of you who got it right. Overwhelmingly, you think that consumers care most about renewable energy. That is also right, but it's not as dramatic as the poll here makes it look. Sustainable food and agriculture has really risen in people's awareness, and that was second to renewable energy in terms of preferred sectors. Fair pay and water sort of much lower down the scale. So renewable energy is the theme that investors are interested in the most. Just looking down the polls as well, global equities is the asset class they're most likely to consider over the next 6 months. Yes, actually what is different is there's still a really renewed appetite. There's still very strong appetite in UK equities. So despite the slump in inflows, we have seen a dramatic decline in people considering that since we started tracking this in 2019. But that is in fact still the most popular asset class in terms of future considerations. And it is more popular with investors than sustainable today. Just coming back then at the end of these intro comments to the key sections in the report, thank you for making it bigger, Mike. A lot of work on demographics and preferences. We do track every quarter, we go to 1,500 fund investors and we track overall sentiment and intentions in the current climate, and sentiment, as Jim will go on to show you, is broadly very low. Having said that, appetite in sustainable investing and funds has remained consistently high. That is the good news. The segmentation we dig into, I've mentioned a bit there. We've seen slight growth in the interest in the social elements of ESG, and also more nuanced views from investors about fossil fuels. There's a growing awareness of it's not all about exclusions. It can also be about transition. It can also be about engagement. So we dig into that. We look at brands and we ask both advisors and end investors which brands they are using, which brands they would consider when it comes to investing. And as I'll go on to show you, there's quite a lot of disparity and there's very few brands which resonate with both the end investor and a more sort of institutional audience and an advisor. So really no brand, with the exception of one or two, who are resonating with retail investors, both the end investor and the financial advisor. That's my intro. Mike, if you don't mind moving us on to the first section before I hand over to Jim. The data in this report came from nearly 5,000 NatRep adults. Each 3 months for the last 3 years, we go to 1,500 fund investors to check in with them about all things asset management, what they think, both about traditional funds and sustainable funds. We've done qualitative research, so actually talk to people about largely about communications. What do they understand? What do they want to see? Are the fact sheets and the sustainability reports doing a good job? And we have 3 years track data plus for most of the data points. Jim, with that, I'm going to hand over to you to talk to us about consumer sentiment.
Thank you, Holly. So we start by just some scene setting in terms of where are people today? What are they feeling about their investments and more generally about their personal finances? And it will be no real surprise to anybody that this is a very negative picture at the moment. So as you can see there, 52% of investors and 54% of cash savers say that their financial situation has worsened over the last 6 months. Obviously, we can see a number of reasons for that, but particularly, of course, this is about inflation. So I wonder if, Mike, you could move on to the next slide. So we also track how optimistic people are about the future. So we ask a series of questions about the economy, about and about the UK markets. But in particular, we ask people, in general, do you think your personal financial situation will get worse, stay the same, or will get better? And what this graphic shows is the number of people who say it will get better minus the number of people who say it will get worse. And our previous low for this was back really at the height of the artifacts of the pandemic. So in January 2021, when people were in lockdown, very much the low point previously. But as you can see, it's really fallen off a cliff recently. So a quite dramatic fall really in sentiment about the future, 43%, minus 43% positives versus negatives for savers. Investors, always a little bit more sanguine. They're a bit richer than savers on average. And obviously they've got a little bit more insulation in terms of their budgets, but still a very negative picture overall. So how is this impacting what people are intending to do? And here we're looking not at all savers and investors, but actually just at fund investors from that tracking survey that Holly referred to just now. And what are people intending to buy? So although the people didn't quite get the answers to the poll right, in fact, in spirit, you were correct. So as you can see, UK equities, the intention to buy UK equities has really fallen since we started doing this survey way back in when we started asking this question back in Q2 2020. And we're showing here the second quarter of the year for each of the years subsequently. And what we can see is that sustainable is actually held up relatively strongly. So you can see that you've got a very strong picture there with 22% of people still intending to buy sustainable funds. Global equities down quite a lot, UK equities down quite a lot. And we've obviously seen some oscillation in some of the other areas as well. So moving on to talk about sustainable segments, Holly, I think you're going to introduce the way we've cut these people up.
Sounds rather painful. Next slide, please, Mike, if you could make this full screen as well. What we do is we start by looking at the general population and we focus in on people who have the wherewithal to invest. So these are cash savers and existing investors. The report focuses mostly on those who are investors today. So you can see that's about 16 million people in the UK today have some sort of a risk-based investment product. We then ask these people about quite a lot of attitudinal stuff about their attitude to sustainable investing, and we segment the audience, and the vast majority, it won't surprise you to hear, still say, even though I care about these sustainable issues to a greater or lesser degree, for me, performance is still the main priority, the main reason I invest, and that is about 8 out of 10 people. Just 14% of people are so committed to their views on sustainability that they say, I'd actually put that first, and performance issues come second when it comes to selecting investments. The rest don't know. The fact that 9% don't know actually shows you that, there's still great levels of uncertainty and lack of understanding and confidence around this whole space when it comes to the end investor. What we do is we then break these people down into cohorts. So for the people, the 14% of people who are investors today, who say their sustainable beliefs come above wanting high returns, those split into two camps. We call them the eco warriors and social champions, fairly self-explanatory there. The majority of those people are the eco warriors. So 9% of all investors today are so committed to their views on environmental issues that they say that comes first for them over and above performance issues. If we look at the 77% who say, I invest largely to make returns, that is my priority, we then dig into their sustainable criteria and preferences. There are various cohorts there. The no nasties, for example, are the people who would be what we might think in the industry as people seeking out ethical funds. It's all about exclusions. It's about what they don't want. That group has been steadily falling over recent years as the trend has moved more, it's less about the very, some would argue, blunt tool of exclusions, and it's become more about transition, it's become more about engagement, it's become more about active involvement with positive as well as exclusion of the negatives. I will say that the largest cohort there are the pure returns group. That's nearly 2 out of 10 of all investors who say they're not interested in anything other than making the maximum returns that they can. They're still likely to be very skeptical about anything ESG. One final change I'll talk to is this year we have split out and segmented the aspirational greens from the pragmatic greens. These are investors who prioritize performance, but they do their primary, if we were to sort of drill down into impact and what they care about, what they want to see, it would be largely environmental issues that are driving them. The difference between the two is the aspirational greens are more unforgiving about holding any sort of fossil fuel in their portfolios. They want to exclude. The pragmatic greens understand transition and prefer that approach. And the slightly more pragmatic greens, they're 15% of all investors today, slightly more than aspirational greens. I'm going to ask Jim now to walk us through one of the cohorts, the social champions. No, I'm not.
So
that was doing you too early, Jim. Apologies.
That's
Before
okay.
I am, of course, going to sort of walk through. We've mapped those segments. This might be slightly easier to digest. You can see in one of the axes there, we've looked at their personal convictions. So the eco warriors, the social champions at the top. If you remember, that's the 14% of investors who say, actually, I put my personal sort of issues and then my values above returns. At the bottom there, you can see the pure returns. They're not interested in anything other than maximizing returns. We've segmented them here visually into people for whom it's very much an environmental question. The yellow guys there are more about the social issues. And there is a group there, the slow and steadies, who are less enthused about ESG investing than many. And for them, it's all about risk and it's all about governance. That is what is driving them. And now I'm going to ask Jim to talk us through one of the cohorts. We've selected the social champions.
Thanks. So looking at this group, and Mike, thank you. So this is one of the smaller groups, as Holly said. So this is a group that is very much guided by social versus environmental issues. So they do put values first above returns, but those values are not necessarily green values. They're a bit more concerned about social issues, social impact, and a bit less concerned about green issues. It's not they don't care about green, but it's not their primary motivation. This group is a little bit more likely to be female than the other groups. It's a bit less likely if we think about it across savers and investors. About 6 in 10 of them aren't investors yet, so they're not a terribly heavily invested group at the moment. They've got medium confidence, so they're not the lowest confidence group, but they're kind of in the middle when we ask them about their personal confidence opening new investment products. They're a slightly poorer segment, and that reflects their age. Because they're a little bit younger, they tend not to have accumulated the same level of assets that some of these other groups have. They're very likely to hold a sustainable investment. In fact, they're the second most likely segment if they're an investor already to hold a sustainable investment. So as I said, although they're not necessarily green motivated primarily, they do tend to own investments that are more impact or sustainability focused. The types of themes that they care about are perhaps more governance or ethically related than the green themes. They do care about green themes and they are worried about greenwashing in particular, but they're also motivated by other types of more specific themes: healthcare innovation, affordable housing, diversity and inclusive finance. And they're also very anxious to exclude sin stocks. So they cite a very large proportion of different types of investment that they wouldn't like to be in. So they select a high number of sectors that they wouldn't be involved in. So hopefully that gives you some flavor of the kind of things that we know about some of these individual segments and the kind of detail that we can get into with individual groups. Mike, if you want to move on to the next slide. So now we're going to talk about the overall appetite for sustainability. So given the scene that I've set of a quite high anxiety about finance, quite a lot of concern about where things are going, one might expect that enthusiasm for sustainable as something that isn't purely returns motivated would have deteriorated over this time, but that isn't the case. Actually, that's remained pretty static. And if we look across the top here, and we've excluded the percentages for most of this graph, but looking at when people might consider sustainable investing, that's actually held relatively constant over time, and you can see quite high levels of enthusiasm across particularly existing investors, where 54% would consider a sustainable investment. But in particular, that group of savers who are most enthused about potentially investing in the near future, 68% of those say they would consider a sustainable investment. Having said that, as you'll notice, that red bar, yes, but I'm not sure when, is a lot bigger than that blue bar, which is yes, and I'm definitely considering doing this immediately. That reflects in general that people aren't necessarily day-to-day super engaged with their investments. People are thinking about this stuff irregularly, and their intentions about it, their intentions to make big changes can be quite vague, and they can be quite slow to really make shifts in the way they're invested, because it's not an activity they're engaging with on a second by second basis. So hence we wouldn't expect those blue bars to be particularly big, but it does make that blue bar for those who haven't invested yet. It does clearly indicate that when they do invest, they are considering investing in sustainable. Mike, if you could move on to the next slide. What's stopping people doing this? So we've got a relatively high level of interest. What's preventing people? So we've shown here both the investors and that other group, the savers, who are considering investing, and what's preventing them. I think for savers who aren't considering investing, as you can see there, their dominant concern is they're just low they're worried about investing in general. That's the big barrier to sustainable investing. It's not so much sustainability as such, it's investing in general that they're concerned about. But overall, across the two groups, what really stands out is that there's a very high level of concern about greenwashing and about mis-selling and what exactly is in the investments that they want to take. As you can see, they're also, for those savers looking to invest, they've got quite a broad range of concerns. They're just generally quite anxious about investing and about costs and about everything there. For investors more specifically, they do worry a bit more about costs and returns and that balance of costs and returns against sustainability as well. If you move on, Mike, next slide. So if we think specifically about fossil fuels, we asked two different questions, two different ways of getting at whether or not people were anxious about investing in fossil fuels or not. We asked this in the top question. We asked people if it was okay to invest in fossil fuels as part of a strategy towards transition away from renewables. And actually, we've seen the number of people who said that decrease by 9% year on year. So that's a bit surprising, I think. I think what we perhaps expected is that the oil crisis, the crisis in energy, would lead to people being a bit more pragmatic about energy and thinking, yes, actually we need gas now. Energy bills are going up today. We can worry about green in the future. But actually, we've seen the kind of the opposite effect, which actually tolerance for fossil fuels has deteriorated as part of their investment portfolio over time. And so that's dropped by, as I say, from 63% to 54%. Having said that, still a majority of investors thought it was okay. So it's not that it's gone into the minority, but enthusiasm for that as a strategy has deteriorated. We also asked people about what they'd be concerned to find in their portfolio. If they were to look at it, what would they be worried about if they discovered they were invested in it? And fossil fuels there, a very similar percentage would be concerned about that, and more people are concerned about that than they were a year ago. So again, that's up. So paralleling what we saw about anxiety. And so both of those things telling really the same story, that actually fossil fuel enthusiasm hasn't increased. Attitudes to that energy source haven't been softened by recent events. If anything, the opposite has happened. So we also asked advisors questions about how they approach sustainable investing. So we went to a group of 100 advisors for this survey, and we also surveyed advisors in past years, and we'll show you some of those changes over time as well. But one of the things we were interested to look at was how they get out sustainable investing. And I think it's an important qualification that a lot of these firms use a centralized investment proposition, unsurprisingly, to do this. And where they don't do that, they often use a discretionary fund manager to get to that. The proportion of people who are doing their own research is actually a bit smaller. They are quite reliant on other people, but where they do use research sources, they're quite dependent on third-party sources. We cited here Morningstar and Square Mile. But as you can see there, about 15%, only 15% really are reading the industry press actively to do kind of their own their own independent research outside of a kind of metric or a centralized investment proposition to their research. Having said that, adoption continues to increase. As Holly alluded to, we've been doing these surveys for a number of years. So we contrasted this with back in 2019, and we asked people, to what extent do you agree that it's part of your remit as an advisor to talk to clients about non-financial investment motivations? And that's really increased quite substantially. 80% now either somewhat or strongly agree. And as you can see in that dark blue bar that we're not giving you numbers for unless you buy the report, you can see that strong agreement with this statement has really increased quite dramatically. So quite a big change there of attitudes over the last few years, or recognition of role that these other types of motivations play in their clients' decision making. We've also, in parallel to that, and so unsurprisingly, increasingly, advisors are doing this as part of their regular fact find. So over the last few years, we've asked this question from 2020 onwards. And as you can see, that's risen to 77% of the advisors that we interviewed asked them about interest in sustainable investing as part of their regular fact find. So it's become quite formal, institutionalized, reflecting that change of attitude about the role of advisors. You can see that increasingly people see it as relatively core. And the people who only ask clients if they think they might be interested has really declined very substantially over the last couple of years. It was only 6% last year, and it's now 5%, probably a significant difference. But really, only a minority of people are just leaving it there. People generally involving this conversation a lot more. And Holly, I think you're going to pick up and talk a little bit about what brands people told us, both advisors and investors told us that they were interested in.
Thanks, Jim. Yes, sorry, Demio doesn't like our slides, so the boxes look a little odd, but if I talk you through this, we've asked both advisors and end investors about the brands they're using or the brands they prefer when it comes to sustainable investing. So on the left there, that represents what the advisors have said. We've said to them, which brands do you currently use in favour when it comes to sustainable investing? You can see the top 10 there ranked in 2022. Top of the pack, Royal London, Vanguard and Lion Trust. By contrast, if you look over to the right-hand side, we look at what the end investor, which brands they would consider were they to take out a sustainable investment. There is more confusion with retail investors. We know particular platforms or asset management brands here have very different customer bases. So Hargreaves Lansdown, for example, are more likely to have customers that are broadly very skeptical about sustainable investing compared to some of these other brands. So there's different groups and there's nuances under the bonnet here. But the thing that strikes me is these top 10 lists are very different today amongst advisors and amongst consumers. And I think that reflects the lack of any brand dominance in this space, where consistently people believe that fund manager X or fund manager Y are doing a good job. Question there about how Vanguard has gone up the ranks, and you know, it's difficult for me to sort of second guess why that is with consumers. I think in part it sort of reflects just a growing brand awareness in the UK with the direct investor of Vanguard, and there is generally sort of goodwill, good sentiment around that brand. There's also been more conversations in the press about can passive investment managers successfully be seen as ESG investors. So I think that with Vanguard kind of in the consumer space probably reflects more of a growing brand awareness in the UK rather than anything very specific in relation to sustainable investments. I think because that lack of awareness and confidence with the end investor, they do tend to still defer to brands they trust overall. So Hargreaves are not there simply because they've got the most customers. They are there because their customers are more likely to say, yes, I would go to them for sustainable investments, it's because they trust them, and it's because they trust them to do the hard work for them and to sort of go out and to build these sustainable sort of portfolios or propositions for them. So a lot of this in the consumer space, where people are still pretty confused about this, can be read in some way as a sort of proxy for general trust. There is, Cam, sort of a size correlation too. And I think with anything, when we ask retail investors about something they're confused about or they don't quite know, the less confident the investor, the more likely they are to say that they trust the bigger brands. So what we do see when we dig under the bonnet is it is more likely that these larger, broad brands who do other things other than asset manager are most likely to be trusted by less confident investors. So it's quite nuanced. What I do sort of pull out of this chart that I think is interesting is that Royal London are doing clearly sort of relatively well with both groups, as are Vanguard, as are Aviva investors. So there are a few groups starting to emerge, and we're seeing sort of emerging consistencies there. Over time, as brands become better known and as potentially some brands have a few scandals to deal with, I think we'll see more consistency amongst what advisors think and consumers think moving forward. Next slide, please, Mike. Oh, additional info and events. Why is the right-hand side red? Do you know, Tara, I in fact asked my marketing guys that same question this morning. It was to make a distinction between advisors and consumers. It shouldn't in any way be seen, as most of us see red, as anything negative. So just to clarify that. Before I move on, I'm being moved on to talk about costings and contact info about the report, which I will of course do. If anyone else has any questions, feel free to ping them through. The report itself, and when we sell reports to groups, we do also come along, the analyst team sort of come and do a detailed Q&A with you, because we know that a lot of the information you guys need, a lot of the questions will be similar to the main questions people have. They'll be answered in the report. But we do have quite detailed data, and we are able to sort of customize that to some degree and to answer your questions and sort of hone in more on the types of customers that you're trying to attract or talk to. The report costs $7,200 plus VAT, but if you come to our nice sales team, our research team, today there is a discount on that to close of play today for $6,500. A final thing I will leave you with is we are going to talk about sustainable investing more at our Boring Money half-day conference. So we are back in action. It's our first in-person event for about 3 years, and we wanted to tackle the main themes of the day as we see them when it comes to all things retail investors. We do have a detailed session in our conference on sustainable investing, and we'll be joined by Gwyl Mason, who's the FCA lead when it comes to sustainable disclosures. So we're going to be really sort of digging into that, sharing some of the work we've done in reimagining sort of fact sheets and disclosures, what that should look like. But we're also going to be hearing from the regulator there, which is going to be fantastic, hear what they've got in mind, hear what's coming up from them. We're also digging into digital advice on the day, so sharing what we know about that, but also checking in with Ruth's joining us. She's the CEO at Octopus Investments, but also the chairperson of Seckle technology firm, and also Octopus Money Coach. So her views on emerging models will be great. And we're talking all things consumer duty, of course, and I'm joined at that by Chris Woolard, formerly the interim CEO of the FCA. So he knows a thing or two about consumer duty, and I'll be digging into that with him and talking about his expectations, or what he thinks the regulators' expectations are today. Very happy to take any questions from you guys, either here or as follow-up. One thing I would sort of say, I think it's really interesting to see the continued interest against, as Jim showed, those really dramatic declines in sentiment really low, which won't surprise anyone. We can see that all around. But the appetite for sustainable funds has held up. It's the third most popular sort of asset class, if we see it as an asset class, fund type with end investors when it comes to future considerations. I do think that communication is so important. We saw that 24% of investors are worried about greenwashing. We know that a substantial number of advisors are worried about the reputational risks associated with greenwashing. And I think there's misaligned expectations as much as any wrongdoing by the product manufacturers. We know that people are looking at the top 10 holdings. They want to see more, but they're actually diving into the holdings to get a flavor for the fund. What's going wrong is they're surprised when they see things in there they don't expect. So 62%, Jim said earlier, wouldn't expect to see fossil fuels. People understand transition increasingly, but I think the key takeout for me there is if there's something surprising in a fund, people respond very well to some narrative around it. So that's just sort of one small example. If people are looking under the bonnet, they see something that looks like an oddity. It just needs a couple of lines of positioning. Too often that explanation is there, but it's hidden in an 80-page sustainability sort of annual report somewhere on a website. So I think it's really a question when it comes to comms of rethinking what information do investors really need? What do they want to know? Which our report will tell you in some detail, and then making sure that your comms talk to those concerns and talk to those points. The final question sort of coming in, do you believe firms are able to deliver on ESG promises with their current technical skills or data? Are they lacking in these areas? We're partnering with Morningstar on some initiatives, and we're looking at the data at the moment, sort of trying to map consumer preferences and requirements to the actual data available on the funds. For me, some of the areas where we have inadequate data still are clearly around the S part of ESG. I'm not sure percentage of women on fund boards is really seen as a sort of evidence of a firm that's a great sort of social warrior. Also, if we look at, Jim, correct me if I'm wrong, but biodiversity, for example, is an area that consumers really care about. We asked you in the polls, you got renewable energy right, but the second sort of thing that people say they care about is sustainable food and agriculture, possibly in light of current inflation being driven sort of both by fossil fuels and by food prices. But when it comes to sort of those areas, sort of sustainable food and biodiversity, there's great consumer interest there, and the data points, of course, are really, really hard to come by. So I think there is still a data challenge. However, Lisa, in the absence of that detailed data, what most investors are doing is they are going into the funds, looking under the bonnet, looking at the top holdings and making their own decisions based on the actual contents of the portfolios, which is why I said earlier, I think the communications have to sort of focus on that a lot more and talk about anything sort of surprising that comes out there. Big appetite, Paul saying, from advisors for more education. I think that's right, Paul, but also I was really struck by how relatively few say that they're doing the research themselves. I think the majority sort of seeing that this is still such a hard area to research credibly and to research well, that they're relying on centralized investment propositions or discretionary asset managers, which I guess, knowing the business model of Parmenion, is maybe what they hoped the takeout would be. Thank you so much, everybody, for attending today. Thank you for your questions, your comment, and your interest. Do join us for that half-day event at the 28th of September if you can. We still have a few places left. I must be getting very magnanimous in my old age because there's no charge to attend that event. So also, if you have younger people that work with you, or people that don't get out much, or sort of haven't been to many industry events, see if there's spaces left and send them along so they can come and meet the Boring Money crew and hear from some great speakers across the industry. Thank you for coming this morning, everybody. Over and out from us, and I'm sure we'll be in touch about the brilliant report that the research team, kudos to Jim and Claire and team for creating. Thank you very much for coming.
Thank you, everybody.